BigBear.ai Holdings, under the ticker BBAI, closed its latest trading session on Friday, May 15, 2026, at $4.14 per share, marking an intraday decrease of 1.66% on the New York Stock Exchange. The stock opened the day at $4.23 and oscillated within a tight channel between a low of $4.10 and a high of $4.27, drawing a trading volume of roughly 18.5 million shares. If you monitor the broad marketplace through popular investing sites or track active data on the Robinhood app, you might look at this minor retreat and assume it is just typical microcap volatility. However, the unexpected reality sitting right beneath this quiet Friday slide is a massive, quiet accumulation of high-stakes defense contracts and an aggressive pivot towards specialized software infrastructure. While retail traders on standard individual brokerage setups are busy chasing consumer-facing tech giants, institutional investors are paying very close attention to a surging short interest that now sits at nearly 30% of the public float. This staggering level of short exposure sets up an incredibly tense tug-of-war between bearish macro traders who doubt the company's near-term profitability and underlying fundamental catalysts that could easily trigger a violent upward squeeze. When people talk about the modern technology boom, the general expectation is that every company with an automated software tool should be printing massive immediate net profits. Investors looking for a solid online investment frequently run screeners on online investing platforms, hoping to find pristine balance sheets with predictable, explosive revenue. The common belief surrounding BigBear.ai is that it is simply another speculative enterprise caught in a crowded marketplace, unable to turn its impressive government backlog into real bottom-line strength. It is easy to look at their recent first quarter report for 2026 and focus entirely on the net loss of $56.76 million against sales of $34.44 million, concluding that the business is burning cash too quickly to survive. But the contrarian take, the deeper layer that forces a serious re-examination, is that this financial profile is exactly what a highly specialized acquisition-heavy defense contractor looks like before its integration efforts pay off. By acquiring companies like Pangiam and Ask Sage, they have built an unheralded infrastructure tailored specifically for national security, federal intelligence, and complex logistics, positioning themselves far ahead of traditional commercial software competitors. To truly understand what is driving the daily swings and massive volume spikes in BigBear.ai stock, you have to look directly at the tension between current institutional activity and macroeconomic pressures. High-growth, low-margin names are incredibly sensitive to broader market sentiment, and we are seeing that play out across every major trading desk from retail accounts to high-end wealth management setups. When short sellers pile into a stock to the tune of almost 30%, they are betting that a company will face a severe liquidity crunch or fail to execute its strategic plans before running out of capital. Yet during the most recent quarterly update, management firmly reiterated their full-year revenue guidance of $135 million to $165 million, signaling immense confidence in their execution roadmap. This predictability and forward revenue is exactly why the stock managed to find solid support near its 50-day moving average of $3.80, even while trading below its longer-term 200-day moving average of $5.43. When a stock displays this kind of technical resilience in the face of heavy short pressure, it tells us that institutional accumulation is quietly matching the aggressive selling, absorbing shares at these lower technical levels. Sector momentum is also shifting in a way that directly benefits highly secure, ring-fenced automated systems. If you use advanced tools like the Interactive Brokers Trading Engine or look at institutional positioning via specialized data feeds, you can see a distinct divergence between commercial software demand and government sector demand. Commercial enterprises are tightening their belts, scrutinizing software budgets and demanding immediate returns on every dollar spent. On the flip side, the Department of Defense, Homeland Security, and global trade authorities are accelerating their investments because they face urgent operational threats that require immediate automated assistance. BigBear.ai secured over $60 million in new national security contracts in the first quarter of 2026 alone, expanding a massive backlogged revenue pipeline that acts as a powerful buffer against broader macroeconomic downturns. Comment below how many shares of BigBear.ai stock you currently hold in your portfolio and whether you trust government contracts over commercial sales. Watching how these multi-year contracts translate into predictable, recurring cash flow is what will ultimately determine whether the short sellers get squeezed out or proven right. If we strip away the recent trading action and examine what the company actually does, the investment thesis becomes much clearer. BigBear.ai operates primarily as a decision intelligence provider, using sophisticated data ingestion, machine learning, and computer vision to help organizations make real-time decisions in complex environments. Their core operational philosophy is divided into three distinct steps: observe, orient, and dominate. The software takes messy, disparate streams of data from logistics networks, battlefield sensors, or supply chains, cleans it up, and models the best possible courses of action. For example, their logistics tools use discrete event simulation to map out route optimization and predictive inventory tracking, which is why massive commercial entities like the Kraft Group and the New England Patriots have partner agreements with them to optimize large-scale event operations. They are not selling a generic chatbot or an automated text generator. They are providing critical infrastructure for high-consequence environments where operational failure is not an option. This brings us to their historical foundations, which stretch all the way back to precursor entities formed in 1988 that specialized in defense intelligence and military analytics. The modern iteration of the company was formed through a major consolidation orchestrated by private equity firm AE Industrial Partners in 2020, leading to a public debut via a SPAC merger in late 2021. For years, the market viewed this entity as a pure consulting firm, with low margins, high labor costs, and limited scalability. That historical baggage is exactly why the current expectation remains so depressed, as many old-school analysts still view it through a legacy lens. However, the recent acquisition of AskSage has introduced a secure, automated platform that supports over 100,000 users across 16,000 government teams. This represents a fundamental shift away from pure consulting toward high-margin, scalable software licensing. When you analyze a company's older reports, you have to look for these subtle structural inflections where the old business model starts giving way to an entirely new, highly scalable revenue mix. Looking at the future outlook, the path forward for this asset will be entirely defined by how successfully reality outpaces the market's negative assumptions. There are a few clear catalysts on the horizon that could dramatically alter the current trajectory of the stock. First, if the company shows significant progress toward narrowing its net losses in the upcoming quarters, it will completely invalidate the short thesis, forcing a rapid covering of millions of shorted shares. Second, the integration of their computer vision and biometric technologies into global trade and border security frameworks provides an enormous growth runway that Wall Street consensus models have largely ignored. On the risk side of the equation, the business must carefully manage its cash reserves and ensure that its heavy backlog converts into liquid revenue fast enough to avoid future equity dilution. If they falter on execution or experience delays in government contract funding, the bearish narrative will gain significant traction, putting additional pressure on the equity. When you look across the entire landscape of modern technology options, finding an asset with a massive government backlog, a heavily shorted float, and a distinct presence in national security is incredibly rare. Whether you manage your holdings through a modern Robinhood stock trading account, use self-investing tools on a premium Fidelity trading platform, or prefer automated strategies like Schwab Intelligent Portfolios, understanding the underlying mechanics of your investments is vital. The core contrast between expectation and reality here is glaring. The market expects a slow-moving, unprofitable software consultant plagued by historical structural inefficiencies. The unfolding reality suggests an integrated, mission-ready intelligence platform that is quietly embedding itself into the core infrastructure of global defense and supply chain logistics. By maintaining a sharp focus on concrete execution metrics, rising backlog values, and institutional short interest, rather than daily microcap price noise, an investor can see the true narrative developing before the broader market catches on. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.